In this video, we're looking at how the payment of dividends for both common and preferred stockholders affects journal entries and eventually the stockholder equity section. To begin with, I'm going to look at the data table, which shows what kind of capital structure we have. As is typical, preferred stock is often listed first, then common stock, then followed by additional paid-in capital. So what we have is an 8% preferred stock. We have a par value. So when you have it listed at 8%, that means those stockholders will get an 8% return for each share of stock. We multiply, and we'll see how we'll do that in a minute. We have common stock, we have the $4 par, we have the authorized amount, and issued and outstanding, meaning there is nothing in treasury because those two numbers, issued and outstanding, are the same. Okay, so first what we're going to do is take a look at each of the journal transactions. So I'm going to do a little shortcut here, and what we're going to do is record the dividends declared on the preferred stock. How do we get that number? Let's take a look. In order to figure out the amount of preferred dividends that will be paid, we first take the 8%, we multiply that by its par value times the number of shares, and in doing so that number comes out to $416,000. When we declared the whole amount of $880 and preferred gets theirs first, well, common gets what's left over. So in order to do the journal entries, we go ahead and do dividends as the debit, as a temporary account, dividends payable, liability, and we show the amount that's going to preferred. We show the next piece for common. In the next two entries, what we're doing is we're closing out the dividends accounts to retained earnings. So if you remember income summary, closing entries, we close out revenues, close out expenses, close out dividends, close out the income summary. So we're doing in two different journal entries here. And then we go ahead and do the income summary retained earnings for showing the amount of net income that is earned. Okay, switching back to our MAL, we have to complete the stockholders equity section. We go ahead and show that preferred stock, the par value, and we include this information about the shares authorized and issued. Same here with additional paid-in capital, so no changes there. Total contributed capital has not changed. What has changed is retained earnings, and we can see the computation of retained earnings by simply looking at the beginning amount, subtract out your dividends, add in your net income, there's your ending balance. So, and that's the finished product there. That one wasn't too bad, was it?